Well, joining us now to put the market mayhem in perspective, Kyle Roda from Capital.com. Kyle, welcome to the program. Yeah, perspective is needed, but this fall we're expecting at the open here locally is dramatic. What can we expect in your view?
Well, futures are pointing to a drop of about 4%, and I fear that it could be significantly larger than that, depending on how US futures continue to trade this morning. We've basically got the Nasdaq futures down by 5%, or did have them down by as much as 5% at the open, indicating that we're really seeing quite a cascade of selling here. And a lot of this could be due to the typical thin liquidity that you get in Asian trade on a Monday morning. And, we've got experiences in the very, very recent history that everyone can point to that sort of illustrates that kind of dynamic. But I think we are getting a market now that's pricing in for a very significant growth shock. There's concerns that we're seeing a bit of a race to the bottom on trade, and that opens up lots of second order impacts and a very dynamic and fluid situation that's hard to price in. We've also got things like oil prices down several percent. Copper prices dropped to the open about 8%, which indicates that this is really tied to expectations for global economic growth. So this looks like a possible burgeoning crash in equities here. Again, one hopes that maybe it's sort of a level of technical elements exacerbating it, but it really can't downplay the significance of what's happening right now and what it means or what it indicates about expectations for future global economic growth.
Yeah, it is a time, a moment that hopefully we won't see in our lifetimes too many times, because this is potentially of historic magnitude. So we are talking about copper locally. We're talking about even gold came under pressure. Was that a bit of a surprise? I read analysis that it was so that folks could cover losses in other parts of the market.
Yeah, well, when you start to see that, you start to wonder, is this kind of forced liquidation? And if that's the case, then this is a market starting to get panicky. I mean, fortunately, we haven't had any kind of issues in money markets or in treasury markets in particular. If anything, there has been a little bit of a bid there, and so there's a safe haven play going on that suggests that there's a level of efficiency still coming about, albeit the move in yields are probably a little bit smaller than what one would expect, given the price action in other markets. One could argue that there is that element of inflation risk because of these policies, and people don't want to sort of obviously run too quickly into these assets if there is a sort of a price shock coming down the pipeline. But really this is again indicative of a market that's pricing in a fairly significant slowdown to the US economy and probably global economy. There is this fear as well that could be compounded by a Trump administration that is dead set on shaking up the global trade order and restructuring the US economy, and therefore is either disinclined to change policy, maybe even will dig in and continue to drive these protectionist policies. And then on top of that too, this has really been driven, or this leg lower has been driven by the retaliatory tariffs from China, and fairly clear indications from the Trump administration that it would go tit for tat with anyone who was responding to their Liberation Day tariffs with higher trade imposts. So again, very dynamic and fluid. There's a growth shock element to these things here that has to be discounted. There's the heightened uncertainty that has to be discounted as well. And once more, although we're not seeing huge levels of dysfunction in financial markets and inefficiency just yet, moves in the likes of gold, which has benefited from this, maybe is a little bit stretched to the upside as far as positioning goes. The fact that that's selling off suggests there is some forced liquidation going on here, and that's when things can really start to feed upon themselves, and you get this cascading effect across financial markets.
Could you flesh out a little bit from the Fed? So we had that jobs data. We have the U.S. Fed Chair, Jay Powell, saying that tariffs could potentially mean inflation, also slower growth. It's got this dual mandate of inflation and jobs, which looks like it's going to be pretty tough to achieve, potentially, if we see a ratcheting up of a global trade war. But also, it appeared through his comments that there's no such thing as a Fed put. He's not coming in to save markets this time around. Is that how you read it?
I read it in probably two ways. There's the kind of policy consideration that I think Powell was trying to convey, which is to say that there are two-sided risks here. That yes, there could be a growth shock. There probably will be a growth shock, but there is likely to be at least a one-off spike in prices, which will significantly change the price level, and it would be concerned, or the Fed would be concerned, that a la a sort of 1970 situation, that responding with easier policy to a price shock might actually inflame inflation and sort of push that out of their control. So they have to take that into consideration. There's the other element too, where you ask what role does the Fed have in bailing out a government for its stupid policies? And arguably, it's not for Powell to cut interest rates to support what is a active economic self-harm in the US. The easiest solution, if the Trump administration was concerned about that, would be changing their trade policy, because that's the underlying concern. Dovetailing into that, I do wonder, with Powell, who's very experienced, quite politically savvy himself, that there's a little bit of, and may I sort of use a little bit crude language, potentially a kind of FAFO approach to this situation, where Powell says, all right, you want to do dumb things? Well, play dumb games, win dumb prizes. We're not here to bail you out, and I'm not saying anything to fix the situation, at least in the immediate term. And as a result, the markets got scared that unlike what was sort of conveyed a few weeks ago in the Fed's dot plots, where they more or less indicated they'd continue to cut rates despite a short-term lift in prices from tariffs, such reassurance isn't going to come very, very liberally. Markets got scared of that, compounded that sell-off as well. And again, it's another one of those reasons we're looking at this possible crash this morning in equity markets.
Yeah, it's all interesting timing as well. We saw a lot of market cap wiped off the big banks in the United States, the big chip makers, big tech. The list goes on and on and on. And we have U.S. quarterlies coming this week. Really begins in earnest on Friday. It's going to be fascinating to hear what the decision makers say about the current environment, because Kyle, how do you make a decision about investment? Even if you're being encouraged to do so, supposedly by this economic miracle that's coming to the United States, when there's this much uncertainty around?
Yeah, and that's, there's several layers of it, right? Is that there's the uncertainty for investors, and that's, being manifested in market volatility as the future becomes increasingly difficult to price in. But, the real impact here is, effectively that consumers can't plan, their consumption, and they're less inclined to spend. And businesses, as we saw in the business surveys, the PMIs last week, unable to hire confidently. They are unable to invest with confidence. There's already talk of mothballing certain projects while this either plays out, or in the worst case scenario, pretty much cancelling them entirely if all of a sudden their cost structure changes significantly. The quarterly earnings will be interesting. We've got the banks obviously kicking things off, and there'll be the element of more or less getting their economic forecasts, but also gauging to what extent is their financial stability risks coming down the pipeline, because we're already seeing a bit of a jump in high yield credit that hasn't really been significant enough to raise concerns about, again, a financial crisis. But still, there are kind of non-linear impacts of these policies, which we want to get some colour from the banks about, their soundness and ability to kind of navigate this storm. And then as we go through the earnings season and start to look at companies who are a little bit more exposed to, the real economy, or, the true producers in the economy, we're going to be looking at earnings downgrades. And that's something that will start to manifest in this cycle, and that we haven't necessarily seen yet, tangibly, is earnings downgrades coming through that reflect the weaker economic growth, how deep that shock will be, how lasting it will be, and what they would necessarily need to see to be able to more or less ameliorate the situation. So it's going to be very, very important colour to the situation that we're currently confronting, and again, for as long as the Trump administration remains pretty dead set on maintaining this trade policy, and then we get this kind of fairly uncertain environment prevailing, you would imagine corporates aren't going to tell us anything reassuring either. If anything, they're going to be painting a fairly negative picture about the next few quarters for company profitability.